Here's an even bigger, broader takeaway. Nothing is new.
That's true too.
Nothing is new. Things are not going faster. In fact, they're probably going slower than ever before in terms of change. Everything that's happened now has happened before. In the Silicon Valley Bank, you look at that, you think that's an unusual thing. Has that ever happened before? Yes. Happened in the 1830s. Almost the exact same thing. Everything that has happened today, you can look back in history and find precedent for it. And that matters. A guy named Mark Lynch. So Mark Lynch and a guy named Nick Adams built Wellington Management up from like 80 million in capital in assets under management to, I don't know, something like 600 billion. Mark retired in 2019. So you go to Mark's house outside of Philadelphia and you walk in, he's got this large room, this large, beautiful room. They call it the Great Room. What's in that room? It's a huge library. It's a humongous library. This is one of the most powerful and important people in the banking industry in the United States over the past 30 years. What does this guy spend his time doing? Reading history.
Books.
Like does reading all that history, does that translate into your success as an investor? The answer to that is yes, absolutely. So what you'll find is that you go around, and people say, history doesn't matter. Everything is different now. These are clowns. People who say that don't know what they're talking about. The fact of the matter is, the more history you know, the better you're able to respond to these things that happen in the market because nothing is new.
Well, I think the one thing in common that the past has with today, and I think Ben Graham, the famous value investor, said that everything changes, but it's the humans that are running the show. And I'm paraphrasing what he said, but basically that's the idea. It was humans causing the panic back in the 1800s, and it's humans causing the panic today. And it will be humans that will cause the next panic in the next 50 years or 100 years. Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, investor, and a founding partner of Sicard Associates, a boutique investment firm founded in New York City. Join me on this quest to unearth the wisdom of the ages. Welcome, everyone. I'm so glad you're tuning into my podcast. For your convenience, the show is available on a multitude of platforms, including Spotify, Apple, Google, Audible, and many more. If you want to keep up with all new episodes, and there's so many more in the queue, make sure you subscribe and please do share it with friends and family. Review it and rate it if you can. Every little gesture matters, and I thank you for it. If you'd like to know more about me, or if you're interested in getting in touch, simply Google my name and it will lead you straight to my website. There's a contact form there, or check notes to this episode for links. I love hearing how you listen to my podcast on your walks, hikes, alone times, drives, trips, and more. I trust that my guests and I are a wonderful company on those adventures. I also enjoy reading how some of you are rehearsing and answering some questions that I ask my guests. I love hearing that. If you're new to the show, please scroll down and check out all the amazing guests I've had over the last few months. If you are serious about investing, money wisdom, wealth, and living a better life, you'll find plenty of episodes with some incredible ideas. For those who enjoy reading thoughtful pieces, I regularly write articles on Substack, which I'm sure you'd find insightful. Find me there and follow me as well. Finally, I'd like to mention my latest book, Crisis Investing. It's a collection of 100 essays that I penned for our clients during the tumultuous times of the global COVID pandemic. These essays are both timely and timeless, providing a unique perspective on navigating through crises. They were never meant to be published, but here they are available to you. Please find the book on Amazon. The book has already received considerable recognition and much love, ranking among the top releases on Amazon in its initial weeks. Thank you for your support and for being a part of my listener community. Now, without further ado, let's dive into today's episode. My guest today is John Maxfield. He studies and writes about banking. He spent 2 decades studying America's best banks, the history of banking, and interviewing bank leaders. He writes a newsletter about banks that has been called the best newsletter on banks. I personally know seasoned stock investors who told me they choose to never invest in banks because they don't understand them. We can avoid banks in our lives though. We don't all have to be equity investors in banks, but most, if not all of us, have deposits with banks. There's a lot to learn and to understand about banks, and in the next hour, John is going to make this difficult topic a lot more relatable. John is a great student of history and comes from a family with a multi-generational history with bank ownership. I myself am a very passionate student of history, and I'm an investment advisor to families with multi-generational fortunes. I was delighted to have John on the show. We talk about his upbringing. John shares the history of US banking seen through various eras. He tells us about the counterintuitive truths about banking. We talk about the origins of banking crisis. We also touch on the silly valley panic of 2023, as John likes to call it. John shares commandments for the banking industry and his own personal definition of success. Please help me welcome John Maxfield. Well, hello, John. Nice to see you. How are you?
I'm doing great. It's a pleasure to be here.
Well, I'm a big fan of your writing. You write about banks, and I think these are some really difficult concepts, and you have a gift and a way to explain things that are really hard to follow, even for industry experts, in a way that's very easy to digest. So I thought we can sit down and talk about banks, both from a perspective of equity investors. We manage money for families at C-Card Associates, but also as depositors. We all have money with all kinds of banks, and we've experienced some shocks in the system and bank runs. And as I mentioned to you, I even had some phone calls I got one of the weekends when the banks were failing about the safety of people's deposits at the banks that end up failing. So it's been a stressful time for anybody that has any exposure to banks, and we all do one way or the other. So that's the big topic for today. But before we talk about banks, I want to talk about you, John. I'm curious about your childhood upbringing, and I like to hear my guests share with me those early stories, if you indulge me, and how you think that time influenced your relationship with money and led you to a path of a bank analyst. I'm very curious to hear more.
Yeah, so it's actually it's a perfect time for this because I'm feeling a little nostalgic because my father just passed away, and so a lot of what I do is a function of kind of what I learned from my father, his business, and all that kind of stuff, and his investing and stuff. And so, grew up in a small town in Wyoming, Torrington, Wyoming, about 4,500 people. My grandfather had a sale barn there for cattle. It was the largest sale barn for cattle west of Kansas City. My father was, if you would talk to kind of the people that he worked with, he was considered somewhat of a savant in the cattle market. He went to law school, graduated top of his class in law school, was going to get an LLM at NYU, which LLM is a graduate law degree. But opportunity came up to buy a portfolio of businesses. He had made a bunch of money trading options in college and law school and buying and selling real estate in college and law school. So he was sitting on a bunch of cash. So he bought this portfolio of businesses, and instead of going to get his LLM at NYU, he just went ahead and kind of owned those businesses in his hometown of Torrington, Wyoming. He then made a bunch of money trading cattle for his dad's sale barn. He then started his own business, which was a cattle feeding business. We had 3 major feedlots and an archipelago, like kind of a group of farms and ranches kind of around these feedlots that supported it. And what you find, he made a lot of money. He's a very successful business. We ended up being the largest cow feeder in the United States. And one of the things that you realize when you're in agriculture is 2 things. One, it's cyclical industry. Like all industries are cyclical, but agriculture is particularly cyclical. The second thing is that in order to survive those cycles and to grow a business, you have to know your banker really well. And so another thing that my family has done for multiple generations, we've invested in banks for 4 generations, public banks, but primarily private banks. And that kind of what makes up the predominant share of me and my wife's balance sheet is an investment in a private bank. And so when the financial crisis hit, I went to college, I went to law school, clerked for a federal judge, did a whole bunch of stuff. Eventually, the financial crisis hit. I realized that I didn't have a good understanding of what caused banks to fail or really even the banking business model. And so I just started reading as many books about banking as I could. That one thing led to another. I got a job writing about banks. Then I was the editor-in-chief of a banking magazine. And now I do I have a portfolio of activities that I do on my own that are related to banking. But it really is kind of to your point. It's about demystifying what is otherwise a really complicated subject for a lot of people.
Well, I'm sorry to hear about your father, and it sounds like he had been an incredible influence on your life and shaped you in many ways. So thank you for joining me today. I know it's a special time, but I appreciate it. So talking more about banks, you have this series of articles that you called Magnum Opus on Banking, and you share a quote. I'll share a quote from it with you. By the end of the series, you will know more about banking than 95% of people who work in the industry. And I think it's true. So you talk about the four eras of U.S. banking and how banking is a lot like other businesses, but it's not. There are some peculiarities about this business. Can you walk us through the history of banking in the United States, and then why is it a different business than other businesses that we might be familiar with analyzing as analysts?
Okay, so those are two kind of big loaded questions. If I don't get to that second one, just remind me and I'll come back to it. Okay, so let's talk about the history of banking. So whenever you want to kind of dominate or kind of like master a subject matter, there are multiple verticals that you have to understand. And one of those verticals in any subject matter is a history. Now, a lot of people think that I'm a historian. I'm actually not a historian. I've just spent 2 years really focused on that vertical because there's so much there. It just takes a long time to kind of grasp that. And so when you think about history in a subject matter, the only way, particularly one as long and rich as banking, the only way that you can really grasp kind of the subject matter overall is to break it down into eras. And that's called, it's a process that historians call periodization. And so what you do is you have to find out, okay, what are the things that causes one era to switch to another era, to switch to another era, to switch to another era. And a proper periodization, it'll be the same thing that causes these switches from one to another, to another, to another. And one of the things that I did over the past, I guess it's now 18 months, is that I went back through the history of banking, and I started in 1790, which was the beginning of the United States. It was George Washington's first inaugural address. And I just read contemporary materials all the way through to today. And the reason I did that is because I'd studied a bunch of subject matters before in my life. I've kind of gone subject matter to subject matter, subject matter to subject matter. And I was always able to reduce, 6 months, 8 months, couple of years. I was able to reduce that subject matter down to a fundamental principle. And then once you reduce it to a fundamental principle, you can kind of pack that away in your brain. And then forevermore, you can pull that out and remember all the stuff, recall all the stuff that you learned and unpack it. But I wasn't able to do that with banking, and I couldn't figure out why. And so through this process, this 18-month process, the whole purpose of that was both to figure out why I wasn't able to do that. And then if I was able to do that, then kind of like fix it and then kind of actually go through that actual process. And what I found was that the problem that didn't allow me to reduce it in the same way was that the scholars had broken down the periodization incorrectly. And so what they had done is that they said, look, one era goes to the thing that separates eras is, and this is my terminology, but it's the presence or absence of a central bank-like authority. As they said, so you go basically from 1790 until 1837, and that's the first and second bank of the United States era. So those are our first kind of central banks. And then there's this period after Andrew Jackson after he vetoes the renewal of the charter of the second bank of the United States. That's called the free banking era. And that goes from 1837 until the Civil War. So that's basically there's no rules. Basically, anybody can start a bank, and there's basically no rules to running or starting a bank. Civil War starts. What happens in the Civil War? The federal government of the Union government, so the government that oversaw the Army of the North, so the Abraham Lincoln's government, they needed to find a way to finance the war. And so they did that by passing the National Banking Acts. And so what the National Banking Acts did is they said, we're going to consolidate all these banks in the United States under national charters, get rid of all the state banks, use those national banks to sell bonds, and then those bonds would finance the war. So then that period goes from about 1863 until 1913. 1913 is when the Federal Reserve Act is passed. The Federal Reserve Act then, according to the current periodization or kind of the conventional periodization, that covers everything until today. The problem is that when you look at the data, you break the data down. I spent thousands of hours collecting data that goes all the way back to the beginning, whether it's bank population, bank failures, bank creation, bank merger and acquisition, when you put these data sets together, and not very many people have put them together for the whole time, going all the way back, and you stack those data sets on top of each other, and then you look at the periodization, when those scholars broke those eras down, what you find is that there's no inflection point in the data. And so you say well, 1913, seems to make sense that the Federal Reserve's birth starts this new era, but you look at the data and there's just no inflection point in the data. And you go back all the way through time and it's the same. So you think if one era is switching to another era, it doesn't cause an inflection point in the data. Is it actually a change of an era?
Right.
My belief is not. And so what I did is once I realized that the periodization was off, I started back over again and then went back through reading contemporary materials back through. And then I found what the thing was that caused one era to change from another era. Now, this sounds really academic, but you'll see in a second that it's actually incredibly critical to understanding this industry. And so what I found is that when you look at the data, what causes these big movements in the data are what I call novel liquidity flows. Now, novel liquidity flows that's when a huge surge of liquidity comes into the system or goes out of the system. And there's two ways that can happen. Number one, it can come into the system from another system. So like from Europe, we had that in the late 1800s. It's like in 1880, the average person in the United States had $4 on deposit. Now you adjust that for inflation and it's something like $27 today, but that's not very much. Then what you had is this huge flood of capital coming into the United States from Europe. Disposable income is born in the United States. People have all this money. They're putting all this money in these banks. The number of banks increases dramatically. And then you go into the Great Depression, and in the 1920s, Great Depression, and that falls. But that birth of disposable income is a huge influx of capital from Europe into the United States. And so that's a large novel liquidity surge. So that starts an era. You then go forward, and then you have another era start in the early 1970s. And that starts with the oil crisis in 1973 when OPEC puts an oil embargo on the United States, totally changes the trading patterns in the entire world. Money floods out of the United States into the euro-dollar market. Euro dollars are dollars. Those dollars then flood back into the United States capital markets. And that's what causes the financial crisis. So you have 1973 to the financial crisis as another era. And what really matters now is then you say, okay, the financial crisis is the end of an era, or at least that we know that now. But at the time, we didn't know that. So the question was after the financial crisis, you're looking at 2010, 2011, you're saying, are we still in a former era, or are we in a new era, or are we in some sort of purgatory where we're between eras? And it's kind of like, we don't really know, or TBD, right? But then when the coronavirus crisis hits, what happens? We have a huge flood of liquidity in the system, and it comes through the second way that liquidity can come into the system. And that is like up through the ground like a geyser. And that's from money creation from the Federal Reserve. And that's what happened. We had this huge flood of liquidity into the system from both fiscal policy and monetary policy. Such a large surge that it actually starts a brand new era. And why does that matter? That matters because when you have an enormous amount of liquidity comes into the system, it knocks the entire system out of equilibrium. And what happens when you knock the entire system out of equilibrium? You have crises. And so what did we see almost there's about 2 years after that huge flood of liquidity, we saw the Silicon Valley crisis, right? Silicon Valley, all this money comes in. They don't know what to do with it. That bank fails. First Republic fails. Signature Bank fails. And so you have all these banks fail. So like that crisis was a function of this novel liquidity surge. And that is a function of trying to move back into equilibrium where the amount of money in the system is relatively equal to the actual demand for money that is in the system. And so that's why that matters. But so if you break it all down, you can just basically think about the whole history of banking like this. You can break it down to 5 piles of money, okay? And the readjustment to equilibrium back from those piles of money. The first pile is when the first and second bank in the United States, when they come in the early 1800s and they add all this credit, that's a pile of money.
Right.
Second pile of money starts in the 1830s when those banks go away and all these state banks come and form because there's no rules and they're trying to make up for the lack of credit because the first and second banks in the United States are gone. So they come in and they create a huge pile of money. That's a novel liquidity surge that comes up through the ground because it's money creation. You then have then that goes all the way to basically the 1880s. The 1880s is when you have the novel liquidity surge from Europe. That's a humongous pile of money. That pile of money, we're readjusting back into equilibrium all the way back until the 1970s. 1970s, you have a huge pile of money from the euro dollars because of change of trade patterns because of the energy crisis. So that's a huge pile of money. And then your fifth pile of money is the response to the coronavirus crisis. Everything in banking we thought of as a function of one of those piles of money.
So if we pause for a second, I'm thinking about two things. One, the U.S. banking system before the Fed and after the Fed. And maybe you can have some thoughts about beyond the Fed. And the second one is the gold standard. The U.S. had a very effective gold standard all the way until early 1930s. And since then, not really. And since the 70s, not at all. And that had some sort of an influence on how liquidity can be quickly created and was not easily created in the era of the Great Depression, for example. Can you talk about those two, Fed and then the gold standard?
Yeah, so the gold standard is one of those things. It's a fiction that people believe in, but it's actually never existed. Mm-hmm. We've ostensibly through time we've pegged the amount of currency we've produced to the amount of gold that comes out of the ground. But you see these crises, when these crises happen, we always take the peg off, always take the peg off, always take the peg off. 1819, 1837, 1857, 1873, you even go back to the Civil War, you go 1893, you go to the crises in the early 1900s, Panic of 1907, you have, the Great Depression, you have the 70s. We've never stuck to it. We've never stuck. Mm-hmm. It's a fiction that people are infatuated with, because they're against this thing this 4-letter word called fiat currency, right? And so whether you agree with the gold standard or don't agree with the gold standard, the fact of the matter is it's never worked. It's just, It has never, ever, ever worked. And if in those periods of time when we were on the gold standard, when you abided by the gold standard, and then we had a crisis that caused us to go off the gold standard, but if you didn't go off the gold standard, it would push the economy into such a deep depression. Now, you have to ask yourself, is it worth being in a horrible depression where people are literally starving to death just to maintain some sort of intellectual consistency with this idea that has never worked? It's a nice thing to think about, but when you really go down and you dig into it, you realize it just doesn't work. But it takes hundreds of hours, thousands of hours of studying this stuff to really understanding the dynamics of this stuff. And that's why it's a lot of people who believe this stuff, they don't spend a lot of time actually digging into it and studying it, seriously studying the book. You see the books that you can see, I know this is just a recording, but you see the books behind me. I have an enormous library that I've studied this stuff going back hundreds and hundreds of years. And it's just one of those things that it's just better for people to understand that you need more flexibility than gold standard provides. The Federal Reserve, now, does that mean that when you have a fiat currency and the Federal Reserve is able to increase the supply or decrease the supply, does that mean that that's a better situation? No, it doesn't. The fact of the matter is, you know what I mean? Humans run the Federal Reserve. Humans are susceptible to error. The reason the Great Depression was a Great Depression as opposed to just one large recession or actually two back-to-back recessions is because of the Federal Reserve. Mm-hmm. What they come in and they say, we're going to decrease the money supply at the wrong time. And that causes this thing to just flood. This causes this thing to go from what was the typical recession into a Great Depression. And not only did they do that once, they did it twice, because they did it not only in 1929 and 1930, but they also did it in 1937 when we were coming out of the Great Depression. They did it again and they pushed us back into the Great Depression. And you can actually look at the Great Depression and be like, well, the Great Depression in large part was caused this World War II. And you look at the death of the World War II, so you think the Federal Reserve, to say that we shouldn't be on the gold standard is not necessarily to say that the Federal Reserve is the answer, because the Federal Reserve is run by humans, and humans are susceptible to failure or to flaws, making mistakes. So it's just one of those things where it's nobody is right and nobody is wrong.
I mentioned to you before we started recording that I picked up a book, One Up on Wall Street, when I was a student, and it set me on a course of becoming a professional investor. But there was another book on the shelf called Maestro about Alan Greenspan that you might know about, that came out probably about the same time. And I skimmed through that book, and it was telling a story of one individual that somehow counts the train cars and knows what the interest rates should be. And I grew up in Poland, and the first decade of my life was a centrally planned economy under communist rule. And we had central planners, individuals that somehow knew what kind of shoe you should wear and how many nails should be produced. And the whole system completely failed in an embarrassing way, as you can imagine. So here I was reading a book about this gentleman that's running an institution that I was not yet familiar with, the Federal Reserve, and somehow he's counting the train cars and knows what the interest rates should be. I put that book away. I walked away with the Peter Lynch book, One Up on Wall Street, and I'm glad I did. I never really understood why we all believe that one single individual, or 10 of them or 20 of them, it doesn't really matter, somehow know what the interest rates should be. The same way we can't have one individual that decides how much a Nike shoe should sell for. The same way there should be a free market in interest rates. But maybe that's something I'll yet get to live and see one day. And I'm curious about your thoughts. Before we get into that, I'm curious about the concept of fractional reserve banking, because that's something that's elusive as an idea to a lot of people. Can you talk about that? How do the banks really work from that perspective?
Okay, so let me answer that in kind of a let me take a broader answer to that. So you think about, and you mentioned this at the beginning, that banking as a business is different than other businesses.
Right.
That's absolutely true. And I don't mean just like it's just different, like how superficially. I mean, it's fundamentally different. It's like the way I describe it is that a bank is like the moon, as a typical business is like the planet Earth. So in a typical business, you're trying to get that thing going. You're trying to jump up off the ground. All your effort is to jump off the ground, to grow. That's all the focus is on that. A bank, it's completely different. Inertia is actually to grow. If you do nothing, you're actually going to grow. You're going to you'll like kind of lift off with no gravity, go off into outer space. And that is because there's this thing called, let's pretend like you're a shoe store, right? You're a shoe store and you want to sell a bunch of shoes. What do? You lower the price. Well, even if you lower the price like 10 cents per shoe, you're still limited to how many shoes you can sell. And that's simply because look, even if you have a big house, there's a limit to how many shoe boxes you can fit in that house. There's just a physical limit. Money, it's not the same thing. You lower the interest rate on a loan, you ease up the terms enough on a loan, there's literally an infinite amount of demand for that. So you say like, oh, John, like, you want to get a loan? Like, we'll lend you on a non-recourse basis. So you aren't actually personally liable for this money. Well, on a non-recourse basis, money at 0.01% interest rate for as long as you want. How much do you want and how long do you want it? You say, well, like, I will literally take an infinite amount of money and I'll take it for an infinite amount of time. Because like, why wouldn't you do that? I mean, now you talked about generational wealth, and that's those clients that you serve. Like, there you go. You now have generational wealth forevermore, right? Just by getting a loan at that rate, right? Well, like, so what that means is that it is incumbent upon the people who run the banks to throttle their own growth. Whereas everybody else running a typical business, it's incumbent upon them not to throttle their growth, but to actually accelerate their growth, right? And so that has a very important, understanding that is very important for understanding banking. And so then you think, okay, well, you have that dynamic, but then you have these other peculiar dynamics of banking. One of them is the amount of leverage that banks use. So your typical business will use they'll leverage up their balance sheet maybe 2 times, maybe 1.5 times, maybe 3 times. Well, your typical bank will leverage up its balance sheet by 10 times. So they'll borrow $10 for every $1 worth of capital. That is an enormous amount of leverage. That leaves very, very little margin for error. Because if the value of your assets decreases by 10%, just 10%, which happens all the time in the cycles that we experience, you're totally wiped out. You're totally insolvent, right? Well, and it's not, but so you look at that and you're like, well, that makes it really fragile. But then you take into account fractional reserve banking, and then you realize how fragile it truly is. So you have a bank that has let's say $100 million in deposits. Does it keep $100 million in cash just sitting there? Waiting for me or you to come in and withdraw money? No, it'll take 90 million of that, right? And make loans from it, right? So that means that it's sitting on only $10 million in cash, right? And so you have $10 million in cash and you have $100 million in deposits. So as soon as people hear that this bank's in trouble, they're going to rush to try to get that 10 million, right? That is available for them. And so a rumor of a bank being in trouble because of that fractional reserve dynamic causes banks to be even more fragile than they are because of leverage. And so and that's why, like, when we saw Silicon Valley Bank would go down, First Republic Bank go down, Signature Bank go down. Why did they go down? Well, they went down because there were people who were concerned about it. But when they were concerned about it, they rushed to get their money out. So they pulled $102 billion out of First Republic. They pulled, I can't remember, I don't remember, $70 billion or whatever it was out of Silicon Valley. And when that money comes out, it causes a bank to go, it's called liquidity insolvent. So it basically turns the bank upside down.
So let's talk about that. You call it the Silly Valley Panic of 2023. What happened?
So you had, okay, so now we can connect to the things that we were talking about. So we had the novel liquidity surge as a result of the coronavirus crisis, right?
Right.
So the government shuts down, everything shuts down in March 2020. We have, on an annualized basis, GDP falls by 30%, which is a larger annualized decline in GDP than we've ever experienced ever before, even much larger than the Great Depression. So the government is sitting there thinking like, oh my God, this is going to be a complete catastrophe. So what do? They flood in a bunch of fiscal relief. They flood in a bunch of monetary relief to offset that. Well, that novel liquidity surge. So then you have all this cash come in. You say, well, like where's that cash going to go? Right. And so that cash goes to a variety of different places. But on the tip of the spear of that novel liquidity surge are technology companies, VC firms, companies like that, companies where people are making really speculative investments. And who of all the banks in this country services those customers? Silicon Valley Bank. So it goes into at the end of 2019, it has $60 billion in deposits. Within 18 months, its deposits have gone up to $190 billion. So it's got $130 billion in excess cash. They're just sitting there thinking like, what the hell are we going to do with all of this money? They said, well, we can't make loans because we don't have the demand for that many loans. They said, well, what about if we go and let's do something safe with this. The safest thing that we can think about. Let's go and buy government bonds with all this money. Like, what's wrong with that, right? Well, the problem is they go out and they buy government bonds, but they buy not short-dated bonds. You can buy like a month bond, one that's for a month, one that's for 6 months, one's for a year. They buy mortgage-backed securities that are guaranteed by the government, and then just long-dated U.S. Treasuries. And so these things are going out like 3 years, 5 years, 7 years. Well, the problem is they're doing that when interest rates are at the absolute minimum, right? Mm-hmm. So that puts them into the situation where if interest rates go up, the price of those bonds goes way down. And that's exactly what happens. They buy all these bonds when interest rates are basically zero. The Federal Reserve comes in and then jacks up interest rates 500 basis points. That causes the value of those bonds to fall. So then if you look at Silicon Valley's balance sheet, you think like, oh my God, this thing is insolvent. This thing is totally insolvent because the value of these bonds have dropped that far. They've eaten up all its capital. Well, in accounting and banking, you actually don't have to do that because you can just hold those until they mature and then just get the par value for them. But the psychology with the investor, with the depositors at that bank are saying like, oh my God, like what if they aren't going to be able to realize par value on those things? So they rush in and they pull all of their money out. That causes Silicon Valley Bank to fail. Signature Bank experiences the same thing. First Republic Bank experiences the same thing after that. So these are people looking at the balance sheets of these banks. They're saying, we don't care that bank accounting laws or bank accounting rules allow you to hold these till maturity and then realize 100% on the, 100% on the dollar for these things. We don't care about that. Like, we're worried the balance sheet right now looks like it's underwater. We're going to go get all our money out. They pull it all out and those things go broke.
Why haven't we seen more banks fail the same way? I'm guessing that they're not the only ones that are caught in this position.
They are not the only ones that are caught like that. But no other, really, if Silicon Valley Bank is that, to understand everything that happened, is Silicon Valley Bank is the most important. Mm-hmm. And Silicon Valley Bank, while other banks saw a surge in deposits, they saw like their deposits go up 20% or 30%. No other banks saw their deposits increase by that amount. So no other banks had so much to invest in these long dated bonds. And so all the other banks on a continuum, all the other banks did have this issue, but it was like they had 2% of the issue, whereas Silicon Valley Bank had 95% of the issue. So it was just the most exposed. And then First Republic fell because there's a lot of similarities between the two banks, the two customer bases. Signature Bank fell because it had exposure to cryptocurrency. Cryptocurrency was one of the other areas where all this liquidity surged into. And quite frankly, Signature Bank just hasn't been a well-run bank for a long time. And even more importantly, they had horrible relationships with the regulators, and regulators are the ones who make the decisions on whether a bank fails or not. So that's the reason that those three banks failed. The reason that others didn't fail after that was because the FDIC and the Federal Reserve, kind of the response to all of this, came in and basically said, like, look, like, you don't have to worry about other banks and uninsured deposits. Like, we'll back those up.
So I like that you separate the two sides, the surge in deposits and then how that money was invested, the long dated, even if it's government paper. When the interest rates go from 0 to 5 in a matter of months, it's hard to be smart unless you're only in very, very short-term paper. So looking at the other side of the equation, there might be other banks that also have that kind of a hole in their balance sheet where they have long-term dated paper that if you had to take the losses now, they would be substantial losses that look like paper losses for now, but if they were forced to, they would have to realize substantial losses. How does that look? Because that's more of a broad-reaching kind of aspect for all the banks.
So how does it look in terms of, like, are there others that have the same issue, or?
That's right. Yeah. Are there others that have a big hole that hasn't been recognized, realized?
Yeah. There are plenty of other banks that have that problem. Not to the same extent as Silicon Valley, but yeah, there are other banks that have that issue.
But it's not as pressing and it's not as big of a concern as it was for Silicon Valley. That's what I'm hearing.
Well, I mean, like, it wasn't even a concern for Silicon Valley. That was just the madness of the crowds, right? I mean, like, Silicon Valley could have sat on that portfolio until it matured and they could have gotten 100 cents on their dollar for that. That was just the madness of the crowd. And so, like, I do a lot of podcasts and get asked these questions a lot. And, like, a lot of times I'll be like, well, what other banks are having problems? Well, it's like, why would I, like, no responsible person who does what I do would ever answer that question, because these banks are fine. All of the banks are perfectly fine. All you're doing by answering that question is feeding the madness of the crowd. That's all you're doing. Yeah. Because these banks, if it's like if a tree falls in a forest and no one's around, like, does it make a sound? I don't know. Maybe not. You know what I mean? It's the same thing here. If I go around, like, pretending like making the sound of a tree falling, like, that's not going to do anybody any good, if that makes sense.
No. I think it's a very sensible way of looking at it. And I think what you emphasize is the confidence. And the confidence, it's easier to lose it when we can transmit information at a speed that we couldn't before. If you had a local bank fail in 1931, or the banks that I've seen fail as a kid in Poland in the 90s, the reach and how quickly the information would spread is nothing like what's happening today. It's on social media. There are pictures of people in front of the banks. So I think that's a very powerful element of that. You can break the confidence in the bank very, very quickly. I think that's the difference between today and anything that happened before. I'm not sure if that's how you look at it.
Now, let me provide a counterpoint to that, because you hear a lot about that. Like, oh, the speed at which information travels now is different than ever before. Well, like, let's look at history and let's find out if that's true or not. So you go back to 1857, okay? Mm-hmm. 1857 there's a major panic that started in Cincinnati, Ohio, when a company by the name of the Ohio Life Insurance and Trust Company went broke. And it went broke because they had an office in New York, and their cashier at that office had made some personal speculative bets that had gone wrong. And so what he decided to do is he was going to take the money from this company and invest it in the stock market, invest it in securities markets, make up for that, then take that out, and nobody would ever know the difference. Because this company was known to be incredibly, incredibly conservative. And, like, the widows and orphans put their money in this thing. The states put their money in this thing. It was one of the biggest, most respected financial institutions in the entire United States at the time. Word gets out, they get a telegram from the New York office to the Cincinnati office. That telegram says, we're going to suspend payment. So that means that, like, a depositor comes in to withdraw money. They're going to say, no, depositor, you cannot have your money. So we're suspending payment for this reason. We have this stuff going on. We got to try to figure out. Well, what happens then to all the other cities around, major cities around the country? Well, here's what happened. 13 years before, in 1844, was the first telegraphic message. What hath God wrought? That was the first message. And I think it went from, Washington, D.C. to Baltimore, something like that. And that was the birth of the telegraph. So as soon as that telegram came into Cincinnati, then telegrams went out to all the other cities, Pittsburgh, Pennsylvania, Baltimore, New York City, all over the country. And then you saw bank runs experienced in all these different cities all over the country. And so the panic of 1857, this was 6 years ago, was the first modern banking panic because it was the first banking panic when there was modern technology. And so really we've had 160 some years of this almost instantaneous passage of information for, these things. So it's like, really when people say like, oh, it's going faster now than ever before. I don't know. I'm not somebody.
I like that point.
I'm not somebody who abides by that. Yeah.
No, I like that point. And I'm always amazed reading books, history about the markets, how information was already flowing. And, at some point there were phone lines and messages going across the Atlantic. So London would know what's happening in New York and coast to coast. So you're right that the people that were in charge of actual trading would know as quickly and as much as you would today. I think the difference is that more people are participating. Even the average deposit that you mentioned at US banks in the 1800s, the $4, now more money and more people have substantial money, not just with banks, but even in equities, even compared to the Great Depression. During the Great Depression, actually a small percent of people was invested in the stock market. Today, and I can find a statistic, I don't remember, but it was a very small amount relative to what it is today. Now everybody's retirement, 401ks, everything is in the stock market. So I think it's broader. More people are affected by it, and more people have more substantial money with banks. But you're right that the message with the telegram can reach the decision makers as fast in 1857 as it does today. Yeah,
it's an interesting question you bring. I bet you're right. I suspect you're right, but I bet the magnitude is not as large as one would think. Here's why I say that. The Civil War is when bonds were first marketed to the general public by a guy named Jay Cook. But then it was in the 1920s, the early 1900s, so like 1900 to like the end of the 1920s. That's when all of these banks started these basically retail brokerage companies. But they didn't call them retail brokerage companies. They called them securities affiliates. And so what these did is they took, because then in World War I, bonds again were marketed across the country to your retail investors, these war bonds. And then these securities affiliates came and they used those distribution channels that were built out to market those bonds in World War I to market securities to just your mom and pops all across the United States. So those two periods really were the birth of kind of your retail investor in the United States. And I don't know what the percentages were, but my guess is that the percentages by the 1920s were actually pretty substantial in terms of the retail investor investing in stock market.
For me, the big takeaway from what we just talked about is what you mentioned, that even the vulnerable banks, had they held, and effectively they will continue to hold this paper, long-term paper until it matures, they will get a par 100% back. I think that's important to know. And
here's an even bigger, broader takeaway. Nothing is new.
That's true.
Nothing is new. Things are not going faster. In fact, they're probably going slower than ever before in terms of change. Everything that's happened now has happened before. In the Silicon Valley Bank, you look at that, you think that's an unusual thing. Has that ever happened before? Yes. Happened in the 1830s. Almost the exact same thing. Everything that has happened today, you can look back at history and find precedent for it. And that matters because, like, if you're a trader, you look back, a guy named Mark Lynch. So Mark Lynch and a guy named Nick Adams built Wellington Management up from like 80 million in capital in assets under management to, I don't know, something like 600 billion. And they became the largest active allocators in the banking space in the United States. They may still be, I'm not sure. They're either one or two now, but Mark retired in 2019. So you go to Mark's house outside of Philadelphia, and you walk in, he's got this large room, this large, beautiful room. They call it the Great Room. What's in that room? It's a huge library. It's a humongous library. This is one of the most powerful and important people in the banking industry in the United States over the past 30 years. And what does this guy do? What does this guy spend his time doing? Reading history. Reading history. And then you say, and then you ask him questions like does reading all that history, does that translate into your success as an investor? The answer to that is yes, absolutely. So what you'll find is that you go around, and people say, well, why do you read so much history? Why does history matter? History doesn't matter. Everything is different now. These are clowns. People who say that don't know what they're talking about. The fact of the matter is, the more history you know, the better you're able to respond to these things that happen in the market because nothing is new.
Well, I think the one thing in common that the past has with today, and I think Ben Graham, the famous value investor, said that everything changes, but it's the humans that are running the show. And I'm paraphrasing what he said, but basically that's the idea. It was humans causing the panic back in the 1800s, and it's humans causing the panic today. And it will be humans that will cause the next panic in the next 50 years or 100 years. So I think that's what we have in common. I'm tempted to ask you about AI, how it fits into the picture. Does it make it worse or better? Or at the end of the day, somebody told me that the quality of questions, the AI cannot ask a question really. It's the answer that you get, but the quality of questions, it's up to the human to decide. And the more books you have, like you have a whole wall behind you, the better will be the quality of questions that you can ask. What's your thought on AI?
So there are things that people say that have no meaning. AI is one of those things. People throw around artificial intelligence, AI this, AI that, AI this, AI that. And then you ask these people, well, what is AI? Like, explain to me exactly what it is. Exactly what it is. What exactly is it? They have no clue, right?
Well,
what exactly is AI? Other than a concept.
So let me, and I think we use AI already in many different ways, all the way from, airline ticket pricing to so many different other things. I think we already use it. We might not talk about it. Maybe we talk about it more now, but the way it's being talked about these days, you get an answer to a more complex question than an online search. So an online search would be, find me the cheapest hotel in Madrid. And it will list by that category the hotels in Madrid. You choose which one. I think what AI can do, and the extent that I experimented with it, it can answer a question that usually a high school student would answer. For example, I was writing an article about people that inherited wealth during the Great Depression. And I was curious how they faced this time where a lot of people were destitute and they were in a position to inherit some of the largest fortunes of the era. So I was looking for people that came of age in that decade, ranked by the size of the fortune and with some description of the source of the fortune. So it's a question I would ask to a junior analyst or really, a high school or a college graduate. Find me and cross-reference 3 or 4 different things. And that's how I see the use for it. So it's actually doing assignments that you would have in high school or in college for you in seconds. And it would take me probably a whole weekend to go through books, find names, find fortunes, find family histories. But this produces the answer within seconds, right? So I think the challenge is, and on so many levels, for example, how the education these days and my education was offered to me, memorize dates, names, and places, a lot of it, or if it was biology, terms and notions and so on and so on. Once you have access to something that can give you that, then a higher level of thinking goes in. Why in the world did you ask that question? Why are you curious about people that came of age, inherited the largest fortunes during the Great Depression? I'm curious, what have they done? How they operated, how much they lost. I'm curious about the lessons for the families that we work for these days, in this time around. What can we learn from this period, right? So I can explain why I'm asking the question, but I think it goes back to what I mentioned earlier. The quality of the question, like, why do you care to know? Just the fact that I will give you the name of all Napoleon's generals, it doesn't mean I'm smart, And I think
I think you're exactly right. So AI, the point about AI is that AI is not a new thing. It is an incremental change to how we just figured out information before. Let me give you a specific example. I went to law school between 2002 and 2005. Okay. Mm-hmm. This was right at the birth of LexisNexis, not long after the birth of LexisNexis and its competitor called Westlaw. What does LexisNexis do? LexisNexis is a precedent aggregator. Takes all these cases that were in these books, puts them online. Right. It makes it easier to search these cases. Right. Mm-hmm. And so when I went to law school, we did a legal writing class. And in a legal writing class, what do? You spend your time in the library. You go and you learn how to find the cases in the actual books. You don't have to do that anymore. Now it's much faster. You just go to LexisNexis. Right. Same thing with like Google. Right. Like before you had to go around and even before LexisNexis, if you didn't have a law library, right? If you didn't have a law library, then you had to go to all these different places to find all this different stuff. So law library aggregates it, then LexisNexis aggregates it, and then you just add some algorithms and things like that just make it easier to pull data from all these different places and put it together, right? Mm-hmm. So you look at ChatGPT. ChatGPT is just like another layer on top of that. Now, as opposed to just you saying, okay, LexisNexis, like what are the cases that I need to make this determination. You go to ChatGPT and you say like, here's the legal question. What is the answer? Right. And it goes out and it kind of like adds that additional layer where it says like, okay, here are all the legal cases and here's what all the legal cases mean. Right. So I mean, AI is like this thing that's very popular. People like to say these words because it makes them feel like fancy. Right. And it makes them think that they're like quote unquote thought leaders. But the fact of the matter is it's just an incremental change on what we've already been doing. Right. And so like, will that make a difference? Yeah. Does LexisNexis make a difference? Yeah, LexisNexis makes a huge difference because like nobody's buying the actual physical books anymore, right? So those middlemen get cut out. Like, does ChatGPT and other AI type of things, does that make a difference? Yes, it makes a difference, but it's like, we're not talking like machines aren't going to take over the planet Earth. You know what I mean? This is just an incremental change that's going to cut out some middlemen, make it a more efficient process, to your point.
You know, early in my career, I was looking into, and I've been in the business 18 years, so it's long enough I've seen a lot of change in how things are done. I remember my first visit to the New York Stock Exchange, and there were still the last of floor traders with the paper tickets, and actually they gave me the paper ticket, buy, sell, bought, sold, that I put in a book somewhere. I don't remember which book. I'll find it one day. But I remember talking to one of the senior people I worked with, and I was proposing to test out some software that would give us access to financials. We could screen for things in a more powerful, quicker way than whatever they were using at that time. And he said, why would you need it? When I started, 3 decades earlier, I had a pencil and a notepad. Can't you work with just that? And I said, I could, but I'm going to be much slower. I'll look at fewer stocks, and somebody else at the other firm has the app or the software, and they'll move quicker than me. So I think I see AI as a tool that can make us more efficient, better, and maybe spending time on something that adds more value than just memorizing the names of Napoleon's generals and stuff that can be looked up.
The other thing I'll say is that AI it's a product of the quality of the information that goes into it.
Right.
Garbage in, garbage out. Garbage in, garbage out. Like you go and you can look up all sorts of stuff and get an answer that is not factually accurate. All sorts of stuff on ChatGPT and find inaccuracies. And in the presentation, you think like, oh, it reads well and makes sense. It's logical, but like it's actually totally garbage. And so if you're a trader, if you are somebody who's serious at whatever academic discipline or whatever business discipline, what matters is truth. The closer you can approximate the truth, that's what it is with trading. The closer you can approximate the truth than somebody else, and the faster you can approximate that truth, that's where all the money is. And that's what it is that's what it is in banking. That's what it is in retail. That's what it is in everything. The closer you can approximate the truth, the better you will do. Assuming you have the portfolio of other of other qualities that demand success. And so, yes, in one respect, AI makes it easier to get closer to the truth, but in other respects, it actually makes it harder to get to the truth because it masks what the truth is. And so there will still be the people where the real value is added, which is the same thing right now, and it'll be the same thing under AI, is that the people who truly are able to discover and approximate more closely than others the truth. And ChatGPT and other AI type of products may or may not help that. In some ways they will, in some ways they won't.
I did a lot of research when I was at different universities, and we would source things from the original. And one of the apps that we were using for, financial analysis, it would allow me to click through and see the actual filing. And when something felt off to my human eye, I wanted to click through and see why this number looks strange. And a human can make a judgment. And to a computer, 1 or 10,000, it's just a number. To a human, in some context, the 10,000 makes no sense, right? A human will say, this makes no sense. I don't know what the correct answer is, but 10,000 makes no sense. So I think the beauty of AI, if it goes in that direction, would be so I can click through and see the source of the information, whichever book, legal book, or an encyclopedia that you sourced it from. Show me the source so that I can see and not be wrong and say a silly thing about, Napoleon's battle or, a financial statement or the health of a particular bank. John, I'm curious about something that you write about, the challenges to conventional wisdom when it comes to banking. There's some counterintuitive truths that you talk about. Can we go over those real quick so that people have a better idea of how how to look properly at this whole industry?
Yeah. So, I mean, there's a variety of, there's a number of these kind of counterintuitive truths, but let me start with one easy one, and then I'll parlay that into something else that your comment about Napoleon kind of brought to mind. The first is that, and you kind of mentioned this earlier, there's this idea in banking that capital is king.
Yeah.
Capital is king, capital is king, capital is king, right? Like the more capital a bank has, the safer that the bank is. And you see analysts all the time. They're saying, like, looking at how much capital a bank has in good times. And what you find is that, for example, Silicon Valley Bank had more capital than M&T Bank. It had more capital than Bank of America on a relative basis, relative to the size of its balance sheet. And yet it failed. You look at Washington Mutual. Washington Mutual is the biggest bank failure in the history of the United States. It went down in September of 2008, I think a week or two after Lehman Brothers went down. You put it on a bar chart. You put Washington Mutual on a bar chart with JP Morgan, Bank of America, Citigroup, Wells Fargo. You say, who had the most capital at that time? Well, Washington Mutual had the most capital at that time. The point being is that capital is not king. Capital, in fact, is what I refer to as a court jester. It's kind of off on the side, like dancing, doing ridiculous things, like distracting you from what really matters. And what really matters is confidence. And that goes back to this idea of fractional reserve banking. Like as soon as that confidence bubble pops, people are going to run and get their money. Doesn't matter how much capital you have. And the flip side of that is that, like, if you're making bad loans, when you're leveraged 10-1, it doesn't take very many bad loans to eat up all that capital. And you don't know if the loans are bad until the cycle corrects. And so like you're sitting there, like you can say all you want about how much capital this bank has or that bank has, or like, you know, like the not performing loan ratio this bank is reporting right now, this bank is reporting right now. You don't know the answer until shit hits the fan. And when shit hits the fan, the only thing that matters is confidence. And so confidence in banking is truly the thing that is king. So that's one of those kind of counterintuitive things that continues to prevail in the banking industry to today. Let me tell you even a more important thing, that if your customers are are people who have multi-generational wealth, and what they're trying to do is they're trying to multiply that multi-generational wealth, to increase the number of generations that have access to that wealth, or to increase the amount of wealth that the next generation has. Well, what's the one thing you want to grab hold of that is your most powerful ally? It's the law of compounding returns. Law of compounding returns. And there's no better type of institution that compounds than banks. These are just pure compounding machines. It's money on top of money on top of money on top of money on top of money. There's nothing in between. There's no products in between. You got to to parlay the money through. It's just money on money on money on money on money on money on money. And so your typical bank, this is what's beautiful about banks from an investing perspective. That's why my family's invested in them for 4 generations. That's why more than half of my wife's balance sheet is invested in a private bank. And then another 20 or 30% is invested in the publicly traded banks. It's because your typical bank, you don't have to be Albert Einstein, and you can earn 12% on your equity every damn year. Every year. Bang, 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 bang. 12%, 12%, 12%. Good times, bad times, good times, bad times. But as long as you're not doing stupid stuff, well, you're compounding at 12% a year. That's pretty damn good. What's the S&P return on average? Like 8 or 9% a year. So you're compounding at 12% a year. So you're doubling your money based on the rule of 72, but every 6 years. Okay. You're doubling your money every 6 years. That is really, really, really good. Well, in order to do that, the people leading that thing, they have to make the right decisions. And most importantly, they have to make the right decisions in good times, when everything else looks great, when there doesn't seem to be any risk, when all the other banks are growing like gangbusters, because again, there's infinite demand, right? So everybody else is saying like, oh, let's just make all these loans. Everything looks great. There doesn't seem to be any risk, right? Well, your good banks, they sit around and say like, at good times, they say like, oh God, like this is not going to turn out well. And those are the people who say like, your analysts get on the calls to them. They're saying, grow faster. You need to grow faster because all your competitors are growing faster. Your employees are coming to your office and they're saying, our bonuses aren't as big as our competitors' bonuses because they're growing faster and they're making more loans. You're not letting us make all these loans. Your shareholders are saying the same thing. Well, their stock is going up faster than our stock because like they're growing faster. Like you need to grow faster. You need a CEO that says, screw that. I don't care. Like, this is in these times is when banks make the mistakes that cause them to fail. So we're just going to be happy with our 12 or 13% return on equity. Yeah, some of our competitors are making 18% on their equity, but we're going to be content with 12%. We're just going to do that every single year. And so then you dig into that and you say, like, what is the thing that allows a CEO to do that? To say no when everybody else is saying yes. And you have to find somebody who is committed to the fiduciary duty. They have got to be committed to the fiduciary duty against self-dealing. And that means that you are taking, and I think you mentioned this earlier, you are stepping into the role, you're putting your company ahead of yourself, right? Putting your company ahead of yourself. And you look at the great bankers, and like all the great bankers did this. A.P. Giannini did it. Mick Blodnick did it. J.P. Morgan did it. Robert Wilmers did all the top performing bankers. That is the one thing that they share, that they took their fiduciary duty against self-dealing seriously. So then you say, well, what is the quality that allows you to take that fiduciary duty seriously and allows you to say, like, I don't care what you say, analysts. I don't care what you say, employees. I don't care what you say, shareholders. Like, we're going to hold the line and do the right thing. It is a presence or absence of tragedy and hardship, and typically early on in their life, that allows them to hold the line on that. And so, like, you have all these analysts out there looking at building these models, these banks, and look at the net interest margin, their efficiency ratio, all these things. Yeah, you have to understand all those things. But fundamentally, the thing that's going to drive your long-term returns at a bank is the ability of bankers to say no. And to determine if that banker has the ability to say no when you need them to say no, you've got to look into their personal histories.
So the one thing with compounding, you don't want to have what I would call game overs. You can't have an interruption where your equity gets wiped out. And you touched on something. I want to explore it a little bit more. You said hardship. You're talking about the management or the founders or the people that are running the bank. Can you talk more about it? I think it reshapes their risk awareness for their lifetime. And I've seen it so many times with so many individuals I've met in the investment world and on many fronts.
So Mick Blodnick ran Glacier Bancorp for from 1998 until 2016. And there's a guy by the name of Robert Wilmers who ran M&T Bancorp from 1983 until he passed away in 2017. If you look at those, and they produced more all-time total shareholder return than anybody, and nobody was even close. I mean, like, they're like, I like this analogy, but I hate this analogy. You'll see why, because they're like the twin towers of banking, but they never came down. They were that, when you look at the skyline of the southern Manhattan, as like the southern tip of Manhattan, like when the Twin Towers are there, how they stuck out that far. That was like Mick Blodnick and Bob Wilmers. And you say, like, okay, well, what was unusual about Mick Blodnick's life? He grew up so poor in a town called Anaconda, Montana, that they oftentimes didn't have food in their house. Like, literally, like, they'd open the fridge or like the cabinets, literally like zero food, like not even crumbs, like there's just zero food. That's how poor he grew up. Bob Wilmers, he grew up he comes from a family in Eastern Europe. An amazing story. We don't have time to get into it now, but like a number of interesting dynamics of tragedies and hardships in their family, an Eastern European Jewish family from Belarus, from a trio of villages along how do you say it? What's the name of that river? Dneiper. How do you say that river? Dnieper. So they grew up on 3 villages on that river. Okay. And just this amazing story. Again, time to go into it, but like, you look at like what allowed them to make the right decisions. It was the fact that they went through these hardships and tragedies, and they're like, well, we don't really care. You look at Brent Beardall at Washington Federal, so they rank 7th in terms of among all banks, all publicly traded banks, about all-time total shareholder returns. What did Brent Beardall do when he was 15 years old? He had to carry his father's lifeless body to the car and then rush off to the hospital. His father never gained consciousness and died a week later. You look at Richard Davis. Richard Davis was the guy who ran U.S. Bank from 2006 until 2016 or 2016. Like, he was the guy. It was under Richard Davis. And because of decisions that he made, you could tie directly to Richard Davis, that U.S. Bancorp emerged from the financial crisis with the highest credit rating of every bank in the United States. Richard Davis, what happened to him early in life? He and his wife and his family leave his parents' house the night before Thanksgiving. His dad is killed like minutes later. Like, it's a tragedy that has lived with him ever since, and it's shaped the way that he became a leader. I mean, you can just go down like bang, 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 all the great leaders, and you find this thing hidden in their personal life. There are exceptions. Jamie Dimon is an exception. As far as I know, he never experienced in sort of acute tragedy or hardship. But Jamie Dimon he's a true savant. He's a prodigy at what he does. And the thing that differentiated him from all the others is that his dad was an executive vice president of American Express. at the same time that Sandy Weil was. And Jamie Dimon knew Sandy Weil all these years. He then gets out of Harvard Business School, goes to work immediately for Sandy Weil. Sandy Weil is one of the greatest empire builders in the United States, in corporate America, in all of time. He ends up taking this small consumer credit company based in Baltimore, builds it into what became the largest bank in the entire world, Citigroup. The fact that he was able to do that was absolutely remarkable. And Jamie Dimon was there for the whole thing.
That's all remarkable. Some of the families we work with have roots in some old, banking operations back in Europe a long time ago. And the trouble with banking is not just the game over of a bank, but also the underlying system of the country. U.S. has a unique situation of pretty much uninterrupted, history economically for the last, 200 some years. In Europe, there were other upheavals that destroyed banks for various reasons. So staying with those banks would have been disastrous to a lot of family fortunes, but that's a topic for another podcast. I just wanted to mention that some people might remember that Buffett is, famous for his insurance investments, but he also owned quite a few banks, and he had to divest from some of the banks because of his insurance holdings. But who knows if Berkshire wouldn't be a bank if he had gone that route as a, compounding business. There are many differences, but one of the differences is that you can have a bank run. The insurance business is not as exposed to something of a bank run nature because people cannot take the money out unless they have a reason and you have to be paid on the policy. But there are other risks to take into account when you're running an insurance business. I think some people learn that insurance business is not as easy and simple as Buffett sometimes makes it sound, but that's also for another episode. John, one last question before I let you go. I love asking my guests about their definition of success. I'm curious to hear yours if you indulge me. How do you think about success in life, in business, in everything that you do?
That's a good question. I've never actually thought about this. So I'll just give you my contemporary thoughts on it. So I'll contemporaneous thoughts on it. For me, I guess the way that I would put that is that we have one life. Each of us has one life, and we don't know how long it's going to last. And we're just like these parasites on this rock that's flying through space. And the question is what is the purpose of this whole thing? Uh-huh. And to me, I think the purpose is the continuation of our species, to contribute to the continuation of our species. Mm-hmm. I think that's the purpose of human life. And so you say there's all these different ways that we can contribute to the continuation of our species. One of them is to decrease warfare, right? Warfare is very detrimental to the continuation of our species. One of them is to take care of this planet, mm-hmm. right? We don't know how long we have on this planet, but we know that eventually it could be millions of years. We don't know, maybe hundreds of thousands of years, maybe an android will hit it, or a huge meteor will hit it. And then what will happen to us will happen to the dinosaurs. And so maybe it's doing what Elon Musk is doing and trying to get us out to another planet where we have a kind of a safety base where we can go off if we have to go there. You know what I mean? But so in my case, the way I kind of fit into the whole equation is that I think leadership is a big part of the continuation, maximizing the continuation of our species, and being a good leader, doing ethical things, doing the right things for the other people, for the planet Earth, for your business community. I think that kind of thing makes a huge difference in terms of the continuation of our species. And so one of the things that I try to do is I go out and I find the absolute best leaders in one of the most important industries in the U.S. economy. And I get to know them. I get to know their friends. I get to know their family members. I get to know these people extremely, extremely well. And I set these people up as prototypes of how to live a life. Because one of the things I found is that if you want to do well, you have to do good. And that's it's just a hard and fast rule that I have found. And so I spend my life trying to kind of promote that message.
I love that. I write articles every other week. During COVID, I was writing every week. And one of the articles that got shared the most and I got the most response about, I called it Return on Kindness. I came back from Berkshire's meeting and I was collecting my thoughts. And I thought, in this environment where everybody's so competitive, at Berkshire's meeting, there's so much kindness from fellow investors and old friends and new friends and Buffett and Munger themselves. It's all about sharing. And I thought that if the whole world was just a little bit kinder, I think it would be a nicer place to live. And I think just today I saw on LinkedIn somebody wrote something about kindness that I reposted. I think in one word, we're sharing one little planet. Let's be kinder to ourselves. I was going to tell you, do you know the book Ergodicity by Luca Dell'Anna? Do you know Luca Dell'Anna? Have you heard of him?
No, I'll order it.
Yeah, I'll send you a link. He was a guest on the podcast. He talks about so many things we talked about today, nothing to do with banking, but more about not having game overs in any pursuit in life or attempting not to have, minimizing those. He has an interesting concept about maximizing or optimizing life where you would be happy with it if it lasted a day. You would be happy with it if you were here for 50 years. And I think even running businesses, there are certain decisions that make sense if you just run this business for 2 years and you walk away with stock-based comp and all the benefits, or if you're actually there for 50 years, right? Like what kind of decisions you would make. And there are more ideas that he shares, but I'll send you his name and the book and the link. I think you would enjoy it. And I think it touches on some of the topics and some of the big ideas that we talked about today.
Yeah, please send that. And let me finish with one thought. And this kind of goes back to the beginning of, so literally my father just passed away. He's a very successful man, ran a very large business that he built himself. And I was in Colorado, which is where my parents retired, for the past 2 weeks, because we knew my dad's health was failing and I wanted to be there at the very end with him. And so did my siblings. And I was literally there at the deathbed, at his deathbed. He was in the hospital. We brought him home so he was more comfortable so he could die at home. And at that moment when he died, he had my little brother was there. I was there. My sister was there. My mom, we were all right there at the bed. And I remember thinking, and I've had this thought ever since that, like, yeah, he made a lot of money. He was an impressive man, an aggressive man, impressive man, built a big business. But when at that moment in life, and all of us, truth, fact of the matter is we're all going to die. And it's at that moment of death, when you pass from living to the dead, that's what matters most. What happens in that moment? Who is there for you in that exact moment? And we were all there for my father. And it wasn't because he made a lot of money. It was because he's a good guy. And so we all have that to look forward to. And you want to make the right decisions. So when you pass, the people that you care about are there for you. And that matters. It matters more who you are than how much you make.
John, this was a very special episode. I really appreciate you joining me today. And I think this message, it's a beautiful message. And I hope it spreads and people get to think and see the world through your eyes and your experience. So I really appreciate you today. Thank you so much.
Appreciate it very much. Thanks for having me.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski. The content of this podcast is for general informational purposes only, and so are the opinions of members of Seacard Associates, a registered investment advisor, and guests of the show. This podcast does not constitute a recommendation to buy or sell any specific security or financial instruments, or provide investment advice or service. Past performance is not indicative of future results. More information on Seacard Associates is available in its Form ADV disclosure documents available at advisorinfo.sec.gov.